What if you woke up one morning, checked your bank account, and the money was simply gone? No warning, no phone call, no court order, just a lower number staring back at you. That is not a hypothetical. That is something HMRC now has the legal power to do. And if you are over 66, there is a very real chance your account is already on their radar, even if you have never missed a payment in your life. Before we go any further, if this kind of information matters to you, do something right now that takes 2 seconds. Hit the like button, subscribe to this channel, and share this video with someone you know who is retired or close to it. Not because it helps the algorithm, but because the people in your life deserve to know this before it is too late. Now let us get into it. There is a rule, one specific rule, that lets HMRC go directly to your bank, freeze a portion of your balance, and take it. No judge signs off on it. No court gets involved. You do not have to agree. They contact your bank holds the amount, and then it disappears from your balance before you even know what happened. This is not something from a distant future, it is active right now. It was quietly switched back on after a pause during the pandemic, and the machinery behind it has been significantly upgraded. The connection between HMRC and Britain's banks is faster, more automated, and more thorough than it has ever been before. Most people over 66 have never heard of this rule, and the ones who have heard of it usually assume it only applies to people who have deliberately avoided paying tax, fraudsters, evaders, people with something to hide. That assumption is understandable. It is also exactly what makes this so dangerous. Because the pensioners being caught by this are not cheats. They are ordinary people with ordinary retirement incomes who built up a tax debt without ever knowing it existed through no fault of their own. Here is the other thing that catches people off guard. Your risk has nothing to do with how much money you have. It has everything to do with where your money comes from and what kind of account it is sitting in. Two pensioners with identical savings could face completely different levels of exposure depending entirely on the structure of their income. To understand your own position, you need to understand 4 groups. Most people listening to this right now are in one of them. Only one of those 4 groups sits genuinely outside HMRC's reach under this rule. The other 3 are all exposed, each in a different way. And the most dangerous group of all is the one that feels the most secure. So let us walk through them properly. Let us start with what this rule actually is, where it came from, and why it matters so much more today than it ever did before. The rule is called direct recovery of debts. HMRC was first given this power back in 2015. In the early years, it was barely used, a handful of cases here and there. Then came the pandemic, and the whole thing was essentially paused. For a long stretch, most people had no reason to even know it existed. But then came a significant change. Following a government announcement in the spring statement last year, the power was formally reactivated, and this time it came back with a rebuilt infrastructure underneath it. The data sharing systems between HMRC and UK banks have been overhauled. Information about your accounts now flows to HMRC more smoothly, more completely, and more automatically than ever before. In the early years after 2015, HMRC used this power just 19 times in total. 19. That old clunky, rarely used version is gone. What has replaced it is a system designed to work continuously in the background, cross-referencing what HMRC believes you owe with what is sitting in your accounts, without anyone needing to manually chase it. And the threshold that triggers it is not high. If HMRC's records show you owe a tax debt of £1,000 or more, they can move. They instruct your bank to freeze that amount and transfer it over. No warning you would recognize as urgent, no court appearance. The first many people know about it is when they go to pay for something and the money is not there. There are some protections built into the system. They cannot leave you with nothing. There is a minimum floor they are required to leave across your accounts. But every pound you have above that floor is potentially recoverable. The protection is thin, much thinner than most people hope when they first hear about it. Now let us go through the 4 groups. This is where you find out exactly where you stand. The first group is the simplest. These are pensioners who receive only the basic state pension. No private pension on top. No savings generating meaningful interest. No side income of any kind. If this is genuinely your situation, and only your situation, then your exposure is low. The state pension alone, paid without tax deducted at source, rarely produces the kind of underpaid tax that triggers a direct recovery action. But here is what I want you to do before you relax and put yourself in this group. Be honest, really honest. Because the vast majority of people who think they are in this first group are actually in one of the next three without realizing it. The moment any additional income enters the picture at all, the calculation changes entirely. So if there is anything beyond that single state pension payment coming into your life, anything at all, keep reading, because the next three groups are where almost everyone actually sits. And here is something worth keeping in mind as we go through them. You might assume that the more money a pensioner has, the higher their risk, that the wealthier ones are the targets and the ones with less are safe. The reality is almost the opposite. The group that faces the greatest exposure is not the wealthiest. It is the group that feels the most organized, the most on top of things, and that confidence is precisely what blinds them to the danger. Hold that thought as we work through groups 2 and 3 because everything builds toward it. The second group is the largest. This is where most British pensioners actually are. These are people who receive the state pension and also have a private pension or a workplace pension alongside it. The most ordinary, most common retirement setup in the country. And it is precisely this combination that creates a hidden tax problem most people never see coming. Here is why. The state pension is paid to you without any income tax taken off at first, but it still counts as taxable income. So when you have a private pension as well, HMRC tries to collect the tax due on your state pension by adjusting the tax code applied to your private pension. They essentially collect two lots of tax through one payment. The problem is that this adjustment is frequently wrong. Amounts change from year to year. State pension rates increase. Private pension payments shift. And every time something changes, the calculation has another chance to go slightly off. A shortfall builds, quietly, slowly, without a single letter that makes it clear. You carry on receiving your money, spending your money, managing your life, completely unaware that in HMRC's records, a debt is accumulating with your name on it. That is the trap of the second group. The debt is not created by anything you did wrong. You did not hide anything. You did not lie about anything. The system calculated something incorrectly, and you are the one who ends up responsible for the gap it created. And here is how quickly that gap can reach the £1,000 threshold that triggers direct recovery. A modest works pension of just a few £1,000s a year, taxed slightly incorrectly for 2 or 3 years running, can quietly build a shortfall of exactly that size. No alarm bells, no red letters. Just a number growing in a database you cannot see until HMRC decides the time has come to act on it. By the time it becomes visible to you, the money is already leaving your account. Now pause here for a moment, because if any part of what you just read is making you think, wait, is that me? You are asking exactly the right question. And I want you to sit with that rather than dismiss it, because denial is the most expensive thing a pensioner in Group 2 can carry into the next few months. Now let us talk about the third group, because this one has changed dramatically in the past couple of years, and it has quietly pulled thousands of ordinary pensioners into danger without them doing a single thing differently. The third group is made up of people who have savings sitting in a bank or building society that are earning interest. This sounds harmless. For years, it was nearly harmless because interest rates were so low that the interest most people earned was negligible, well within the tax-free allowance. Nothing to worry about. That has changed completely. With interest rates significantly higher than they were just a few years ago, even a modest savings pot can now generate enough interest to push you over your personal savings allowance. And the moment that happens, tax becomes due on the excess, not on all of it, just the portion above the allowance. But that amount left unpaid becomes a debt. Here is what makes this particularly dangerous. You do not have to tell HMRC about your savings interest. Your bank does it automatically. Every year, at the end of the tax year, your bank reports exactly how much interest your accounts earned directly to HMRC before you have even thought about it. HMRC knows the figure. They know whether it pushed you over the threshold. They know whether the resulting tax was paid. If it was not paid, because you did not know it was owed, that is a debt. And here is the bitter irony. The account that earned you the interest, the account that reported that interest to HMRC, is the same account they can then instruct your bank to reach into. The savings that created the problem are sitting in the exact place they can collect from. Most people in this third group have absolutely no idea they are in it. They did not move any money. They did not change anything. The rates shifted around them. Interest crossed a line they were not watching, and now they are on HMRC's radar without ever having received a single clear explanation of why. Think about what that means practically. You could have exactly the same savings you had 5 years ago, same accounts, same bank, same routine, and be in an entirely different tax position today. Not because of anything you chose, but because the world changed while you were standing still. Right. Here is something important before we get to the fourth group, because the fourth one is the one that will surprise you the most. If this video is opening your eyes to something you had not considered before, take 30 seconds right now and do one of these three things. Leave a comment below telling us which group you think you are in. Share this video directly to someone in your family who is retired, or save it so you can come back to it after you have checked your tax position. Your engagement on this video is what gets it in front of the people who need it most, and the people who need it most are the ones who will never think to search for it. Now, the fourth group. The fourth group is the one I have been building toward, and it is the group that catches the people who are most certain they are safe. These are pensioners who have a small amount of income coming in beyond their state pension, something like part-time work, a little freelance activity, or rental income from a spare room or a second property. Not large amounts, not complex arrangements, just a modest extra income that tops up the pension. The people in this group tend to think of themselves as financially aware. They have always managed their own affairs, they know roughly what they earn, they feel organized, and that confidence, that very specific sense of being on top of things, is the thing that blinds them to what is actually happening. Here is the problem. Income from part-time work or rental activity is very often not taxed at source. That means the responsibility for declaring it and paying the tax on it sits entirely with you. If in any given year that declaration was not quite right, maybe the rules shifted, maybe a small amount slipped through the cracks, maybe it just felt too small to matter. A debt accumulates, quietly, without fanfare, and here is why HMRC's rebuilt system is specifically designed to find this group. The new infrastructure cross-references data from multiple sources. Rental platforms report to HMRC, payroll systems report income, bank accounts show funds moving in. The system takes all of that, compares it against the tax actually paid, and flags the gap automatically, with no human needing to investigate it manually. A pensioner with an active bank account, a regular deposit pattern, and an income stream that does not have full tax deducted at source is exactly the profile this system is built to detect. The very independence and organization that Group 4 pensioners are proud of makes them more visible, not less. So now you have heard all four groups. One is genuinely protected, three are exposed, and the exposed ones are not exposed because they did anything wrong. They are exposed because of how the tax system interacts with the most ordinary retirement incomes in Britain, and because HMRC's new machinery is specifically built to find exactly those interactions. Let us make this concrete with a number, because abstract risk is easy to dismiss. £800. Why? That is not a dramatic sum. It is not the kind of figure that makes the news. But £800 is the kind of amount a pensioner on a fixed income might lose under a direct recovery action, and for that person it is not a footnote. It could be the difference between meeting the bills in a difficult month and not meeting them. It could wipe out what took months to save, and it arrives without a warning they would have recognized as urgent, just a balance that is suddenly and inexplicably lower. HMRC is required to leave a minimum amount across your accounts. They will not take everything, but everything above that floor is accessible to them. And the pensioners who have done the responsible thing, who have saved carefully over decades, are the ones with the most sitting above that protected line. The safety net protects the floor. It does not protect the savings you built above it. Now, what do you actually do? The answer is simpler than you might expect, and it does not involve hiding money, restructuring your finances, or doing anything unusual. The single most important thing you can do is find out what HMRC currently believes your tax position is before they act on it. Most of the debts that trigger direct recovery are debts the pensioner did not know existed. They were built from miscalculated tax codes, savings interest that crossed a threshold silently, or side income that was not quite correctly accounted for. The pensioner had no idea. And by the time they found out, the process was already in motion. The move is to get ahead of it. Check your position now while the initiative is still yours. Go to your personal tax account on the government's website. Look at what HMRC's records show, and compare that picture to your own understanding of your income. If there is a shortfall building, even a small one, it is almost always significantly easier and cheaper to deal with when you raise it yourself than when HMRC comes for it. Sorting it out proactively can turn what would have been a sudden, unexpected deduction into a manageable planned arrangement that you control the timing of. And here is something important to understand about how direct recovery actually works in practice. The power is specifically designed for people HMRC considers to be those who can pay but are choosing not to. People who have received repeated correspondence and ignored it. People who have buried the letters and hoped the problem would dissolve on its own. The moment you make contact and engage, the moment you are clearly someone dealing with the situation rather than evading it, you move out of that category entirely. The system was not built to punish the pensioner who picks up the phone. It was built to recover money from the person who never does. So the act of checking your position all by itself begins the process of moving you toward the protected side. There is also a timing element here that you need to know about, because it makes acting sooner rather than later genuinely important. Every autumn, HMRC systems complete the process of pulling together the interest data from the banks, everything your savings earned over the previous tax year. That is the moment when fresh shortfalls appear in HMRC's records. And with the rebuilt system now running continuously in the background, that is also the moment when new gaps get flagged and new recovery actions can be initiated. The window between now and that annual reconciliation is the clearest opportunity you have to get your position reviewed and sorted on your own terms before the autumn process turns a quiet, unnoticed shortfall into an active debt with a deduction attached. The pensioners who come through this cleanly are not the ones with the most money. They are not the ones with the most sophisticated financial arrangements. They are simply the ones who looked at their own position first, found the problem while it was still small, and dealt with it before the system did. Here is what the practical steps look like, spelled out clearly. Work out honestly which of the four groups you actually belong to. Not which one you would prefer to be in, which one genuinely reflects your situation. Remember that almost no one is truly in the first group once you count every source of money coming in. If there is a private pension, a savings account earning interest, or any kind of side income at all, you are in one of the other three. Then go to your personal tax account on the government's website and look at what HMRC's records show for your income and your tax position. You do not need an accountant to do this. You do not need to write anything down in advance. Just look at what they see and compare it to what you know. If those two pictures do not match, if HMRC's records show income or a tax position that does not line up with your own understanding, that gap is what you need to address. When you do contact HMRC, one of the most useful questions you can ask is whether your tax code is currently correct for all of your income. The wrong tax code is the single most common cause of the quiet shortfalls that lead to direct recovery actions. If your code has been miscalculated, getting it corrected stops the problem growing any further, and stopping the growth is half of the solution. The whole objective is simple. Make yourself someone who is already engaged, already aware, and already dealing with the situation before HMRC's system gets there first. Because here is the thing that matters most out of everything covered here today. None of this is about whether you are a good taxpayer or a bad one, not one of the situations described, the Group 2 pensioner with the slightly wrong tax code, the Group 3 pensioner whose savings silently crossed an interest threshold, the Group 4 pensioner with a small rental income. Not one of them involves someone who deliberately avoided paying what they owed. Every one of those people paid what they were asked to pay, every single time. They followed the system as they understood it. The debt that appeared in HMRC's records was not created by dishonesty. It was created by a miscalculation, a rate change, a rule they were never informed about, a threshold that moved without anyone telling them. That is what makes this different from the traditional idea of tax enforcement going after people who cheated. The rebuilt system does not make that distinction. It does not ask whether you meant to underpay. It looks at a number in its records, compares it to a number in your account, and acts. So the protection you are looking for is not honesty. You already have that. The protection is knowledge, and the willingness to act on it before someone else acts for you. The pensioners who stay safe are not a different kind of person from the ones who get caught. They are the same people. They simply happen to check in time. Now you know what the rule is, you know how it works, you know which group you are in, and you know exactly what to do this week. The only question left is whether you do it now, while it is still your move, or whether you wait and let it become theirs. One last thing before you go. If you made it this far, you now understand something that most pensioners in this country have never heard explained clearly. That knowledge has real value, not just for you, but for the people around you. So here is what I want you to do. Think of one person in your life who is retired or approaching retirement. Send them this video, not with a message, not with an explanation. Just send it, because the people in those exposed groups are exactly the ones who will never come across this on their own, and they deserve the chance to check their position before the autumn reconciliation makes the choice for them. The like button and the subscribe are there if you found this useful. But more than that, the share is the one that actually matters today.